We're glad to have you back. This is still Business Nigeria. And in February, the CBN Monetary Policy Committee, under the leadership of Dr. Yemi Cardoso, raised the monetary policy rate by a staggering 400 basis points to 22.75%. According to the CBN, this tightening was necessary to curb inflation and put the economy on a path of sustainable growth, given the current instability in the financial market. Well, let's get insight into this. A partner, Director, Tax Reporting and Strategy, PricewaterhouseCoopers, Mr. Kenneth Erikume, joins me via Zoom from Victoria Island, Lagos, to continue this conversation. Good afternoon, Mr. Erikume. It's good to see you.
Good afternoon, Tolu, and I'm looking forward to our chat as always. Thanks for inviting me.
Yeah. NPR now stands at 22.75%. Asymmetric corridor plus 100 basis points minus 700 basis points. CRR now stands at 45%. Only the liquidity rate was left at 30%. I know you would like to take this one after the other. Can you explain to us how this impacts us? Will this really rein in on inflation as expected?
So thank you, Tolu. So obviously the MPC meeting was much expected because a lot of people actually anticipated additional tightening coming through from the central bank. And even the IMF had already predicted some months back before the adjustments that inflation could soar up to 44% if the central bank fails to tighten monetary policy significantly. And there were several things driving this, the issue of inflation, which currently sits at about 30% as we speak today. Largely the inflation is, if you see the big contributors, it's coming from food prices and it's coming from transportation. We all know the cost of diesel and petrol has been skyrocketing, and even issues around food security and things like that has been a challenge from a Nigerian perspective. So it wasn't a shock that NPR was increased by 400 basis points to 22.75%. Now, what could that measure, as well as the other measures, and I'll come to the others later on, could it really rein in the inflation rate? What Nigerians should be aware of is that these measures do not yield results immediately. So there's a gestation period under which some of those initiatives will begin to bear some fruit. But the textbook answer would be that, when you're faced with, significant inflationary pressure and high inflation, you use monetary policy to actually tackle it. And one of the ways you can do that is to use the monetary policy rate, or increase rates. In economic terms, we say tighten interest rates. Now, what that is supposed to do is twofold. Number one, it's supposed to ensure that people have an adverse inclination or are averse to borrowing, right? So they do not want to go and take cash, which will lead to more money in circulation. They would rather invest their money with the banks because they're able to earn higher return. So the expectation is that, over time, we'll begin to see people, invest in money market instruments, and as much as possible, that would mop up some cash. The other thing that you would also see is a fast tracking of settlements of debt. Because if NPR is in the region of 22.75%, it means that commercial interest rates, for the real sector, which I worry about, sufficiently, will be headlining 25% to 30%. So we would see, the honest borrowers trying as much as possible to go back and repay their loans, which will lead to, more money out of circulation. Already, personally, I've called my bankers to tell them, the little basic hanging on my head. I want to pay it up as quickly as possible.
As soon as you can.
So those are some of the things that would happen. But, we need to tackle the issue of food, and these are some of the risks that could make, some of these measures not work. Food security. In 2022, we had severe flooding, and as you're aware, we have the security challenges in many of the states, especially in the north, where food production is driven from or derives from. So we need to really deal with the issue of food security to complement some of all these initiatives. And that's why in the past we've seen the central bank try to intervene in areas which fundamentally do not relate to monetary policy, right? Trying to go into food security and social security and things like that. Because if those things do not work in tandem with the monetary policy, you may not derive the results you're looking for. The other thing we need to significantly try to boost is local production. Because, using the monetary policy is a short term, it's like taking a sledgehammer and hitting the problem. But we need to look at, can we boost production so that on the supply side, we have more than enough supply, for food, commodities, and products. And once those products are competing for, limited, number of cash, it means that prices will come down. So it's important that we do not pursue all these measures without looking at boosting production. So the issue of increase of the cash reserve ratio, it's very simple, Tolu. What that does is to say, for now, we're increasing the minimum cash that banks must have with the central bank to 45%. And that means that, the bank cannot invest that money. They can't do anything with the money. They must place it with the central bank. Of course, it would mean that the banks do not have excess cash to play around with, and it's sitting there as a reserve. And that would also ensure that, the money supply is also tackled as well. And the final thing you mentioned, which is the asymmetric corridor, which was changed from plus 100, minus 300 to plus 100, 700. It tells you how the central bank will borrow and lend to commercial banks. So, banks, the CBN will lend to banks at about 23.75% if you add the MPR to plus 100, and then if you take out minus 700 basis points, it means that the central bank will borrow to the banks at 15.75%. So there'll be an inclination from the banks as well to invest, in the central bank, which would then lead to a situation where, the cash in circulation drops significantly. So those are, the measures, from the parameters which you mentioned, would, in terms of the textbook, it's supposed to actually lead to a reduction or a management of the inflation rate. But like I said, without other measures, monetary policy may not be effective, because you have to work with fiscal policy, you have to work with ensuring that there's food security and all that for it to work effectively.
So it looks like we have a lot of work cut out for us following the decision of the central bank. You hit my second question because I wanted to talk about the impact on the real sector, which is already contending with macroeconomic challenges at the moment. But I want to also ask, will this not affect the role of banks, in the financial intermediation, which should be their way? Will this not affect it in the Nigerian economy, considering these figures?
Yes, you're right. And I touched on the issue of the real sector, the manufacturing and so on. They have to borrow at significantly high rates. The current situation of things is that there is no bandwidth for them to pass cost to customers. So when these interest rates, when this interest cost comes into their books, their ability to pass on that cost to customers is very limited. So Oxfam has done quite a number of studies of the Nigerian market. The disposable income and the capacity of people to take on additional costs is very low. So what you could see in the long run is that people may not just be able to afford, a commercial price of goods and services, and it would mean that it would cascade, to lower demand, and also ultimately lead to these manufacturing companies and other companies suffering losses. Already, they are grappling with the issue of foreign currency. When you overlay the interest cost on that, it could be very problematic. And why I started with that is the impact on the banking and financial services sector, because the banks could then begin to see, and this is not a prediction, but it's just sound logic, that the banks could begin to see that these companies are unable to meet up with their obligations as at when due. Micro, small, and medium enterprises will struggle to service their debt, and this will further defer the improvement of local production and capacity that we are seeing. Like I said, in the news, we've been seeing the publication of the listed companies, and telcos and manufacturing companies already posting significant foreign currency losses due to their foreign currency liabilities. So credit risk and credit management will become an important issue for the banks, and we may begin to see a lethargy from them to lend to companies, depending on how they profile the borrowers and the ability of those borrowers to pay back in the medium to long term. I think on the micro lending side, which is the guys below the banks, the people with the money lending licenses and so on, they already lend at significantly high rates, but their rates will go up. And we wouldn't be surprised if we begin to see more defaults in that space. And therefore, they would need to invest in robust and automated recovery mechanisms for non-performing loans. So those could be some ripple effects from the banking and other financial institutions side, which is why strengthening their credit risk mitigation function would be an important issue for these players.
Analysts have also argued that key drivers of Nigeria's inflation are largely supply-side variables, and of course, the CBN ways and means of funding. How does that come to you? And it's a two-in-one question because time is fast spent. What's also your understanding of the initiative by the central bank to address the foreign exchange scarcity or hike that we've seen that is hitting the naira so badly? We see that debts are being cleared quietly, things are being done. What do you make of these two issues while we wrap up this segment of the show?
Yes, so thanks to Lou for highlighting that. We are an import-dependent country, and therefore the devaluation in our currency would obviously lead to adverse effects in terms of what we are importing and the cost of what we're importing. When you look at our import profile, a lot of it is in the petroleum and petrochemical space, right? So when you bring in those items when we're importing fabrics, importing petrochemicals, importing wheat and other products, the impact of the exchange rate means that, the price of goods and services would obviously cascade, right? And therefore, managing and bringing the currency under control cannot be totally removed from these other measures which the central bank is trying to do. So it becomes very important from a government side that we look at what we can do, from an exchange perspective to boost more liquidity in the market. And the easiest thing and the low-hanging fruit that stares all of us in the face is hydrocarbons, for us to ensure that production of hydrocarbons is ramped up, now and going forward, and ensure that we're able to get, our FX proceeds from that, and it's kept and it's utilized in the market. The other thing we need to do, because I mentioned petrochemicals, is, can we fix the refineries and deal with the issue of the refineries? Are we going to concession them out? Are we going to keep them? If we're going to keep them, we have to fix them and ensure that they are commercial. And of course, the other thing which I think government needs to look at, and I know a lot of mentions have been made around outflows of illicit funds and implicating, crypto exchanges and things like that. But can we then begin to look at mobilizing diaspora remittances as well, to ensure that we have a clear strategy of how we mobilize investment from the diaspora and mobilize remittances from the diaspora. Nigeria is now low cost as well, because when you look at the markets we are competing with and our exchange rates, goods, our services are now cheap, right? When you convert our salaries to dollars, if you did that several years ago, you came up with more dollars. Now you're coming up with a result that gives you less dollars. Countries that found themselves in that space also looked at outsourcing strategy. And I've said this a number of times, that we speak English, which therefore means that in the global space, we're quite attractive from a service perspective. And now we also have low manpower, even though infrastructure is a challenge. But we need to ensure that we mobilize that strategy around outsourcing and connecting to the global market in that regard. And the final thing we need to look at is obviously gas commercialization. So if we can do all of these things, as well as, because we cannot do the monetary policy alone, we need to mobilize all the other areas where we have strength, and ensure that we get our exchange rates under control. And then we move to the next step, where we begin to ensure that productivity is boosted. I think with those measures, we can begin to see some positive results.
Brilliant. As usual, I've been speaking to Mr. Kenneth Erikume. He is the director, partner with tax reporting strategy, PricewaterhouseCoopers. Tax reporting and strategy. Thank you so much. I appreciate your time.